pips short of our target before continuing on its direction in the current bias. So if we're going to be extremely strict and exact, because we want in our history no losses, we want only wins. So the price action is promising us that it's going to go up. How up? It's going to go up at least to our pre-TP1 zone and possibly to TP1. It may go to pre-TP2 and it may even go to TP2. But the higher price action goes up, the less likely it is to keep going up. It weakens strength the higher it goes up. So we want only the sure ones. So what do? We go only for the pre-TP1 or its zone. So if these are our targets, 23.6, these are our targets, 38.2 and 61.8. The pre-targets will be 23.6 and 50, or a couple of pips approaching it. So this looks perfect. We are going to get now from where price action is now to that green line, that's about 10 pips. Well, let's see exactly. This green candle closed at 0654, right? 1.0654. And the green line is 1.0663. That's 9 pips. Can we be satisfied with 9 pips? Absolutely. Why not? Because we know that those 9 pips are absolutely going to be ours. Those are our 9 pips, more than likely 10. More than likely it's going to hit the 23.6, which is, it's going to be 12 pips. And it's also fairly likely it'll go even higher, maybe to this green line, 0678, giving us more than 20 pips. But we don't know that until price begins to go there and the indicators indicate a continued movement toward those pips. We don't have that. And like I said, the first target, which is a pre-TP1, is a certainty. That's what we want. We want the certain ones. After it transgresses or crosses over that target, after it hits it, it may retest it and continue to the upside, or it may reverse, or it may come close and not even hit it and reverse. We're not sure yet. So we have to tread carefully. What we do know is we're going to get these 9 pips. We're going to get these 9 pips. So we go up an hour. And what happened? What happened? We got the 9 pips. And even more. So we got the 9 pips that we wanted, right? That was our target, our TP, which is take profit. We got that, but we even got the exact fib level, 23.6, which would have been, that is at 1.0665. So that would have been 2 pips more. However, if we would have gone exactly for that one, and price gave us only 9 or 8 pips, according to our zone, the green line is the zone, then price would have done what we forecasted to do. We would have accurately forecast this setup. We would have accurately interpreted and won, but we would have lost if we had set our target as the exact price level. That's why we don't go. We have to use the Fibonacci retracement tool to get an idea of the zone. We'll see these fib numbers, which are divinely established, those are the ones that have to hit because they have to hit by nature. But like I said, if the strength to the downside is such that as much as price tries to go up to hit our targets because it has to, it'll just touch it. It'll touch it very conservatively, and it'll get the heck out of there and run back down to where the larger sentiment lies, to the downside. That's why we got to be extra careful. And let's not be deceived by saying, oh, but look, we have a low and an extremely lower low. And then we have a low and then a noticeable, but barely noticeable, higher low. So that's a good signal of a bullish convergence or bullish reversal coming, right? Yes and no, because it was a yes, you see. But it was a no because it wasn't significant. It was only enough for 9-ish pips. That's why we go only for the pre-TP1 and get out of there. Now what happened? Now what's going to happen? See, the oscillators all indicated upness, and it did go up. But now we move into the next hour, and now we don't know. Will it continue upward? I suspect it will. But I don't want to go by what it looks like or what I feel like. But I would say so. I would say yes. It does look like it wants to go up because the price, according to the RSI, did move up out of the oversold zone. But right now, I have no positions open. I'm going to wait. I'm going to wait and see. We got our 9 pips. And now we wait to see what else happens. Look, we have all this downness again, see? We have all this bearishness. But the strength was enough to push price back up. Now, the higher up we go in price, with the price action, toward these various profit targets, the weaker our assurance is that the next target and the next level and the next target is going to be hit. This one, the pre-TP one, which is the 23.6 or a few pips short of it, is always supposed to be our target and nothing more. That is my key. That is my secret ingredient. That is my super duper win, always win strategy. Don't go for the 38.2, which is TP1. Don't go for the 50%, which is pre-TP2. Don't go for 61.8, which is TP2. In some rare instances, when you have that much confidence that it's going to happen, when you have all the oscillators, all the indicators are showing, so yeah, sure, you can chance it. And it's very likely. It may be more likely to occur than to not. But the most reliable, the most optimal target that you can set, that you can almost guarantee this is going to hit, is the pre-TP1, which is 23.6% or a few pips short of it. On any swing, any chart size, any asset or instrument, always go for only that, and you will get that. Now, consider this. Emotions all the time want to jump in there. And we've all heard, all the experts, the educators, the master traders, they always tell us that 90% or more of our approach to a trade is emotional. It's psychological. It's greed-based, fear-based, and impatience-based. We get emotional. We are emotional creatures. That's not necessarily a bad thing. But in trading, we have to be as robot-like as possible. Here's an instance where emotions can really be a downfall in a trade. So you get these 9 pips and you're supposed to be out of there, right? But you say, but look, all the indicators are saying we're going to get more pips, man. This is going to 38.2, man. This is going to go probably to 50, maybe even to 61.8. Listen, if you're using other strategies, other techniques, look, the Ichimoku or some other type of indicator that is strongly telling you, or even news reports that's telling you this is going to go up, it is going to go, well then, invest in that. But this strategy is a strict scalping strategy, which I highly recommend for any newbie. Start here, because with this, you'll learn how the overall stuff works, and you'll make pips immediately, and you won't be pressed to learn all these other things, such as the fundamental news. This is simple. If you learn little else, this is a great beginning where you can see profits instantly and easily. Simply stick to the rules. So what happens is when you see all this momentum to the upside and you jump in and then it fails, then you lose what profits you were gaining. But now, if you win, okay, see now price wants to act. Now you actually do see a bit of a harmonic pattern or harmonic pattern wannabe. You have an X point here, A, B, C, D. So more than likely price will go a little higher and then come on down 10, 20, 30 pips over the next 24 hours or so. Each of these candles is 1 hour. Now, let's say that you win. Let's say that price over the next 12 to 24 hours does go higher and higher and higher. Even if you went long and won those many pips from here, let's say it goes to the 50% or the 61.8 level, which is TP2. If you win all those pips, you got 20, 40-ish pips, 30 to 40 pips extra. You say, well, I went for the pre-TP1, I got that, and I went for the rest of it because I thought and I felt, and the oscillators seem to say price is going to go further up. Okay, so then let's say you win. If you win that, but it takes a whole day or two before price actually climbs to those levels, you're talking about 24 hours, right? If price actually goes to these levels, the 50% and the 61.8, and you win all those pips, but it takes 24 hours. What if it takes 12 to 24 hours or even more? If price begins to consolidate and drag its feet before it hits those targets, in those 12 to 24 or more hours, you could have jumped on other assets and within a few hours done the same strategy. Look for a viable setup based on the same idea. Look for the RSI to give you discrepancies relative to the price action. Find the lows of price and the RSI and the other oscillators. Look for the highs. When you find that, you can jump in there and just 2 or 3 hours, you can gain 15, 20, 30 pips. So instead of waiting for 12 or 24 hours, if you were to go for the longer one, which is more risky and less reliable, here it's less reliable and it's taking much longer, maybe a whole day or so, to get 30 or so pips. In just 3 or 4 hours, you could get the same amount of pips by simply jumping on another asset, another swing, another setup, and just a few hours do the same strategy and get the same amount of pips roughly. It's just that you got to jump and look around, jump around and look on other assets and see if you find an appropriate setup. So let's move forward and do that again. Let's take this out of the way. And we already have the idea now of these green price levels being our zone, the zones that we are targeting. So I don't need to draw them again, but I'll leave one of them up. I'll leave this up so I don't have to redraw it. Leave that there. Now, this, get it out of the way. Okay, let's move forward in time. What do we see? Now, the price action can be very colorful and entertaining, but no, we're going by the RSI more than anything else. We're looking for two highs that are not at the same level, or two lows that are not at the same level. These two lows were at the same level, but they nevertheless were able to help us see a move to the upside, and we capitalized on that. So, see, had we stayed and gotten more than just those 9 pips, look how long it would have taken. It would have taken us 24 hours to get 40 more pips. And in just 4-ish hours, maybe 6 or 8, maybe on another asset, we could have gotten the same amount of pips. So, is it better to get 40 pips in 6 hours or 40 pips in 24 hours? That's my point. All right, moving forward. See, it's okay that we missed those pips, is my point. Please understand. It's okay that we missed these pips. If we want those pips, we're going to get those amount of pips on another asset and a more reliable setup based on my pre-TP1 targets. That right there in a nutshell, folks, is my efficacious strategy. All right, here we go. We're moving forward in time, and we're looking for what? We're looking at the RSI. We're looking at the RSI. And we're looking for 2 high points or 2 low points. Now, we have a high and a lower high, and it's a discrepancy from the price action, which is a high and a higher high. See? So that's a nice setup there, but it's not so nice. It's not that discrepant. This is kind of level, and this is only a little bit discrepant, which means what? From this swing, from this low to this high, we're going to get some pips. We're going to get some pips, but not many. So we can skip this, even though we're going to see price is going to go a little bit down. And if it goes a lot down, it doesn't matter. We don't know that it's going to go a lot down. So right now, we don't care because this is not an optimal setup. Is this a bearish divergence condition? Yes, it is. Is price going to go down and we can jump in on take a short position right now? Yes, but we don't know how many pips, so it's not worth it. And it may go down 5 or 10 pips to satisfy the requirement of a bearish move. This divergent condition requires a move to the downside, but we don't know how much. And if it's only 5 pips, only for the larger sentiment to continue to the upside, then it's a waste of time. So again, we don't take every signal. We're looking for optimal, reliable signals. And there you go. And there you go. Price didn't go down. That small amount of bearish divergence was not valid. It was not strong. It was not reliable. It was not optimal. It was risky. And it's a good thing that we avoided it. Okay, we have overbought again. See, again, we have this point and this point. High and a lower high, but on price, a high and a higher high. Again, we're gonna see a red candle. That's all we're gonna see. It may be a small red candle, it may be a long red candle. Doesn't matter. We don't know. We want to take trades that we know are going to give us X amount of pips. And when I say X amount, I mean like give us at the very least 10 pips. But even that I wouldn't go for. 15, okay, but 20, absolutely. Because if we're trading with roughly $1,000 in the account, and we go for one standard per trade. One standard per trade. 20 pips, you got $200 within a few hours with little work. So, 2 trades like that in a day, you have $400 in a day. So, of course, over time, you'll increase your balance, you can increase your lot size, but we're concerned, for the most part, the immediate situation. We're trading with $1, or one standard, that is, $10 per pip. So we're going for 15, 20 pips per trade. 2 of those per day is very reasonable, especially when you're going only for wins with this optimal setup. And you're using different assets, so it's easy to find these setups. 2, 3, 4 of these per day is likely. Maybe even 5 in 8 hours of trading. Who wants to trade 8 hours? But yeah, in just 3, 4 hours, say from 7, 8, 9, 10, 11-ish, sometime before noon, 4-ish hours, maybe 3-ish hours per day, trying to avoid Fridays if possible. Yeah, 2 or 3 of these a day with 15 pips per trade, you're talking 45-ish. I mean, if we went 30 pips a day on 2 of these trades, that's great. 30 pips is $300 on one standard lot. And anything more than that is just icing on the cake. So this is very doable, but if you take a loss, you see, if you take a loss of 10 or 20 pips for using a stop loss that gets hit, or for taking a position and price goes in the undesired direction, then you will stress, get emotional, impatient, try to chase trades, possibly end up losing more, and you feel desperate, or for taking a losing trade. So how do you avoid losing trades? Go only for the optimal setups. Go only for the optimal setups. What is an optimal setup? As I said, we want a significant divergence or convergence condition between the price action here and the RSI or the other oscillators. The RSI to me is the strongest indicator, but the stochastics comes in second, and then the MACD's third and fourth, and some oscillator. I just use it there just in case it agrees with the other oscillators. Then it adds strength to the confirmation. All right. Do we have a position open now? No. We have a high and a slightly lower high. Then we have a slightly lower high again over here. But over here, we have a high and a significantly higher high. So can we plot the Fibonacci retracement tool at this time? Yeah, tentatively, just to begin to set up for a forecast to the downside in this case. Now, what day is it? That's important too. Well, here, this is Sunday, Monday, Tuesday, Wednesday. So, this swing began at Monday, 12 noon. So, the New York session was bearish, and we are coming upward on Tuesday, 1 o'clock in the morning, 2 o'clock in the morning. So we have all this bearishness on the London and New York opens on this Tuesday. And we have this strong swing to the upside. So since you have Monday, Tuesday, Wednesday, all this, you have more than, you have what? 0640, 60, 80, 700. You have you have about 140 pips to the upside in this range of price action. 140-ish pips in 2 days. That's a lot. So it's not very likely that price will continue to the upside. So if it is going to reverse to the downside, it'll do so on hump day. Usually the end of Tuesday, Wednesday, and look, we're into Wednesday now. We can expect that alone, that information alone is a signal to the downside. You're at the top of the Bollinger Bands here, so that also can be a signal to the downside. You have all this overboughtness on the oscillators. So yeah, it really looks like price is getting ready to go down. So if I go to the next hour, right? If I go to the next hour, which I'm not going to do yet, it'll probably be more telling of whether the price is going to continue up or reverse to the downside. But now, if I do that, if I don't take a position right now, but wait, if I were to wait right now and jump into the next hour to see if, because I'm treading carefully, I'm being very conservative, if the next hour shows a significant bearish bar, maybe 20 or 30-ish pips to the downside, I say, oh, I was right. Price was going to go down, and it did. By the time I get in, I will have lost the 20 or 30 or more pips that I could have gained had I gotten in now. So I could wait, if I'm going to be extremely conservative, for the next bar to come in. It'll be greenish, it'll be flat-ish, or it'll be red-ish. But if it's significantly red, I would have lost pips that I could have been winning. So what should I do? Be extremely conservative and don't jump in right now? Or should I jump in right now? Should I pull the trigger now? Well, what I personally would do, I would jump in right now, because the spinning top formation on this candle is a reversal signal. We have a significant structure right here because all of this. Okay, now let's use this green price level to delineate our, or to reveal a price level that is significant. See this point all the way to the left over here. Price hit again over here. Price respected this as a floor, as a ceiling. It had to zoom through the ceiling in this case. It respected it over here as a floor, respected it again as a floor over here, finally transgressed it, and it took all this strength. Price comes back up and respects this ceiling zone again and drops. When price finally does, after a double bottom over here, climb way back up, it appears that it wants to again respect this ceiling zone. So that, plus the fact that